It's Jim Lund. And I currently serve as board chair for the Minnesota State University Mankato Foundation. Today, I'd like to share with you some strategies that you might choose to employ to save you money on taxes and at the same time achieve your charitable goals. Over the last 40 years as a financial advisor, I have done exactly that, helping people save money or trade what they would have given the government in the form of tax in favor of using those dollars to support local nonprofits that they care about. And by doing so, they increase their wealth for themselves and for their families. I have a document that I'd like to share with you where we start out with some of the simplest ways to give and then get into the more complex. First asset that I've listed here is gifts of cash. Cash is easy to give, but it's also probably the least efficient way to give or least efficient asset to give. An appreciated asset would be more efficient, and we'll get into that example in a moment. But cash is easy to give, and cash contributions from individuals qualify for a tax deduction up to 60% of your adjusted gross income in the year that the gift was made. If you have any excess uh, above that amount, it can be deducted over the course of the next 5 years as well. So that means you have the year of gift plus five, or a total of 6 years to be able to use charitable gifts as deductions on your tax return. As I mentioned, although it's easy to give cash, they may not be the most efficient. And so gifts of stocks, bonds, mutual funds, appreciated real estate, any appreciated asset typically is a more efficient asset to give. Why? Because when we gift that asset to the nonprofit, you avoid the capital gains tax on that. And back to the gift of cash, in order to have the cash in your pocket to be able to give to the nonprofit, you had to have paid income taxes on that prior to it going into your checking account. So when you think about that, it actually costs you more than dollar for dollar to gift cash when it only costs you pennies on the dollar to donate or gift an appreciated asset. I'm going to use an example. I think examples is how we learn the best. And so then therefore, let me give you a scenario here where in this case, the donor is in a 30% combined ordinary income tax bracket. I'm just choosing, 8% state tax and 22% federal. And for somebody in a 22% federal tax bracket, that would suggest that they're in a 15% federal capital gains bracket, and then again, an 8% state bracket in this case. So a combined bracket of 23%. And let's say this individual owns 100 shares of a stock, 3M, you name the stock, up to you. They purchased it back when it was only $20 a share, and it's now currently worth $100 per share. So I'm going to share with you the example of selling the stock and gifting the resulting cash after taxes are levied versus gifting the stock to the charity directly. So again, the market value of the stock was $10,000. Cost basis is $2,000. Therefore, there's an $8,000 gain. The tax on that gain would be about $1,840 at a 23% combined bracket. Therefore, the gift to charity would be $8,160. Now, by gifting that $8,160, there's a charitable deduction. It's an outright gift, so you could take, in essence, the 30% tax benefit from making that gift. 30% of 8160 ends up being 2448. Total benefit in this example, $10,608. Now let's change this a little bit. Let's say instead of selling the stock and gifting the proceeds to the charity, we instead just simply gift the stock to the charity directly. Now we have no capital gains tax avoidance, as you see in the right-hand side. Therefore, the entire $10,000 goes to the charity. And because you're now gifting $10,000 to the charity at a 30% combined bracket, your tax write-off should represent about $3,000 in benefit to you. Therefore, that's a total benefit to you and the charity of $13,000 instead of only $10,608. That's a pretty simple example. Other assets that you could consider gifting are interest generated from stocks, interest or dividends, interest or dividends from bonds, CDs, or other assets that are just not being used. A very common one these days is using a part of, or either all of, or a portion of your required minimum distribution. Those um, who are subject to required minimum distribution have the right to be able to create or gift what's called a QCD, a qualified charitable distribution, from their IRA in lieu of receiving it as taxable required minimum distribution. There are rules on this, limitations, and so on. I'm just going to go through kind of the high level review of this. So for those of you who don't need your required minimum distribution for income's sake, you might choose to contribute some of it or all of it to charity. Those individuals, in order to qualify for a QCD, have to be 70 and a half or older. I know that the current required minimum distribution age has increased, but for purposes of a QCD, the age limit is still 70 and a half. The amount that you can contribute, at least in 2025, is $108,000. That number does change annually, or can change annually, I should say. And therefore, you'd have to check, depending on the year that you're looking at this or reviewing this video, as to what that limitation is. Any amount above that limit is just simply treated as a regular IRA distribution, and then therefore subject to income tax. Now, this distribution must be paid directly from the IRA custodian to the qualified public charity. Um, so you can't receive it and then give it to the charity. It has to actually go from the custodian directly to the charity. You can't have your hands on it in order for it to qualify as a qualified charitable distribution. Your financial advisor can help you make this contribution. I've been asked the question, can a QCD be used to fund a charitable gift annuity or some other charitable trusts? The answer is yes, but there's a lower limit applied for that purpose. And we're going to get into in a moment the explanation of these different types of tools that I'm just mentioning here, a gift annuity and a charitable trust, because those are more complex tools. The next tool or the next strategy I wanted to share with you is a donor advised fund. These tools have actually become very prolific. They're uh, probably the fastest growing technique within the charitable giving sector as to people setting up donor advised funds because they're very simple to set up and administer. It's a donor advised fund, or DAF for short, is a type of charitable giving vehicle where individuals make an irrevocable contribution of assets to a sponsoring organization, like either through the community foundation, like the Minnesota or Minneapolis Community Foundation or Mankato Community Foundation, or financial services companies like Fidelity or, oh gosh, Schwab. There are a number of them that offer this type of service. From my perspective as a financial advisor, it's really just a tool to facilitate the gift of appreciated assets. You know, when we would have folks that wanted to gift a stock or a bond, we'd have to, or worse yet, maybe a mutual fund, although that's an appropriate asset to give, it does take some administration to be able to get it in the hands of the nonprofit organization. Um, they have to have a brokerage account set up, and then there needs to be an electronic transfer of that asset to that brokerage account. And then once in the charity's brokerage account, then it needs to get sold for cash. And so there's a number of um, uh, processes that need to go through in order to get that in the hands of the charity. With a donor advised fund, it's actually quite simple. The assets being gifted to the donor advised fund and then sold immediately within that donor advised fund for cash. Um, And there are times and then, a check is cut to the nonprofit organization. So in essence, the nonprofit doesn't have to be involved. There isn't administration or paperwork that has to happen on the nonprofit's end. It's all being done on the donor's end or through that donor's financial advisor typically. So they're really just a way to facilitate gifts. And then there are times when people don't know when they want to make those gifts to the nonprofit. Like, for example, there might be a windfall. Let's say they sold a business or they received some kind of a payout through their employer of company stock, or, there's different reasons why people get windfalls throughout their financial life. And they're looking for a way to save money on taxes. A donor advised fund is a great way to do that in the year that they receive that windfall, but then they might choose to dole out that money to the various charities that they care about over time rather than giving all of it as a lump sum in that one year. And remember, I mentioned that there's the year of gift plus five to be able to take the charitable deduction on your tax return. So that enters into that calculation as to how much can I reasonably give away to also take advantage of the tax benefits by making those gifts. Just as an example, a donor advised fund is technically a charity in and of itself. So that's why once you've given an asset to a donor advised fund, even though you're in control of that donor advised fund, um, it's considered by the IRS as being a charitable gift to a public charity, and therefore you can take charitable deduction on your tax return in that year. Um, and then from that point forward, any distributions from that donor advised fund have to be made to a public charity. It cannot go to a private charity or maybe, like a private foundation that you might set up in the future. It would have to remain in the public domain in essence. Okay, enough said on donor advised funds. Let's move on to life insurance. This is a great way for one to be able to leverage a gift. For example, I was talking about gifts of cash, which cost you more than dollar for dollar, and then appreciated assets, which cost you pennies on the dollar. Life insurance is also a pennies on the dollar type of gift, because when you think about it, let's say, and in fact, I've set this up in my own situation where I've made MSU the owner and beneficiary of a life insurance policy that will pay out $100,000, but I didn't put in, or over the course of my lifetime, it will not have put in $100,000 in premium to that policy. It's probably closer to, let's say, half that. Of course, it depends on how long I live and all that kind of stuff. But at the end of the day, the intention is that the premiums are less than the death benefit that the organization is going to receive. And although a policy could be set up like I did for that specific purpose, you could also choose to take a policy that you're not needing any longer, or maybe a policy that you just don't really count on to provide the insurance proceeds for your family upon your death. And instead, you might name as the beneficiary of that policy the university or the foundation rather, and or other charities that you choose to want to make a gift to. And in fact, in my case, I actually have two different charities that I'm making the beneficiary of that death benefit. So it can be flexible. That was my intent there. Companies can make charitable gifts as well, cash and securities and equipment. They also have matching gift programs. And why I wanted to bring that up at this juncture is because if, as an example, you're making a premium payment on this policy that's owned and the beneficiaries are public charities, if you have a matching gifts program through your employer, that employer could actually help reduce the cost of that premium that you're paying, uh, or at least your responsibility toward that premium. So let me just use an example. Let's say the premium annually is $1,000. Well, if you've got a matching gift program through your employer, you kick in $500, they match it with $500, and there's the $1,000 premium for the $100,000 insurance policy. See how that can really be used to leverage what you have available? The reason why I set up that life insurance policy, I did it years ago because back then I didn't have the kind of assets that I have today. And my biggest asset was my ability to earn an income. So it was a way for me to give back by and leverage my gifts by using current cash. But again, but in a leveraged way as opposed to cash on an outright basis. And don't get me wrong, I'm not trying to steer you away from giving cash and giving assets on a current basis or outright gifts. There's no substitute for that. But I got to tell you that I've had the experience with so many donors who have said, when I'm all done using my money, that's when I'll give it away. And so usually that's, through a will via a bequest. But although that works, no problem, it's simple. The problem for me is, and I, by extension for them, they never really then in that case get to enjoy the fruits of their labor, the fruits of their gift. If they knew that there were ways that they could give it away sooner and see how these gifts and maybe even kind of have some, well, not kind of, but have some influence on how those gifts are being used for programming and so on. I think, I found that most people really enjoy that. And so it's as we get into these life income plans that I'm going to go into next, that's where this really comes alive. So entering into a life income plan is just simply that. It's really a deferred or a planned gift because what you're doing is you're choosing to retain an income interest typically in the gift. Um, so we just recently had a real estate gift of some farmland. And in this particular case, um, the donor slash owner of the property was renting the farmland to a farmer, local farmer, and getting paid, somewhere in that 2 to 2.5% range on that asset. And, in talking with that donor, she intimated that she could stand to have some more income. And the reason why she was going to wait to donate this property to the university at her death is because she needs that income. Well, through a charitable gift annuity, which I'm going to go through here with you now, she was able to simply increase the income by trading it instead of getting rental income from the local farmer. She was now transmitted that asset to the university or to the foundation, technically, and the foundation then entered into a contract with her to pay her a 5% income stream for the rest of her life. So the benefit of that is she went from about a 2.4% income stream to a 5% income stream. And because that was more than what she needed to achieve her income goals, she decided that some of that real estate should be an outright gift. To be very exact, she gifted 160 acres total, but 60 of those acres were an outright gift to the College of Ag, which is now being used as a laboratory for students, which is awesome. And then the other 100 acres was set aside, sold, um, the cash reinvested, and that's what we're using then to pay that donor the 5% income stream for the rest of her life. So there's a lot of flexibilities here, as you can tell. We were able to kind of divide it up in a way that made a ton of sense for her. And when she's all done, when she passes that 100 acres, the value of that 100 acres will then be used for the nursing program. And that's again one of her objectives was to benefit the nursing program at the university. So that was really cool. That was a gift of real estate. As you can see here, it could be funded with cash, it could be funded with stock or any other type of appreciated asset. Um, again, I like appreciated assets over cash because we get a triple tax benefit by doing that. What's this triple tax benefit? By using an appreciated asset, we get capital gains tax avoidance. We remove that asset from the taxable estate. So upon death, there won't be any estate taxes being levied. We get a charitable deduction at the outset of the gift to take against our ordinary income taxes. See how those are three major taxes that we have to deal with, and we're choosing to reduce them get rid of them in favor of controlling that asset by giving it to a local nonprofit. Go a step further now and talk about a charitable remainder trust. There's a couple of different versions of a charitable remainder trust. There's an annuity trust and a unitrust. And the difference between them is just simply an annuity trust, kind of like the charitable gift annuity, is a fixed income stream for life. It's decided up front at the time that the trust is set up and it's funded. The so it's a fixed dollar amount paid out from that point forward. Whereas a charitable unit trust is a fixed percentage, but based on a typically an increasing value. I'm going to give you an example. Let's say the assets inside the trust are generating a 7% rate of return, and we're paying a 5% income stream to the donor. Well, instead of on an annuity trust, it's a fixed payment of 5%. Let's assume, I don't know, I'll just throw out a number. Let's say it was $100,000 just to make the math be super easy. That's $5,000 a year that would then at 5%, that would be paid out to the donor, to the beneficiary of the trust. And which, by the way, the beneficiary of the trust doesn't have to be the donor, but typically it is the donor. It could be other family members or other people that the donor wanted to provide this income stream to. In any case, that $5,000 a year is fixed under an annuity trust, but with a unit trust, think about it this way: 7% rate of return, 5% being paid out. That means 2% is going back into the corpus of the trust, increasing the value of that trust. So now instead of it being $100,000 or 5% calculation on $100,000 the following year, it's going to be a 5% calculation on $102,000 because that 2% got added to the corpus of the trust. So now all of a sudden we've got an increasing income stream annually going to the beneficiary or the beneficiaries. By the way, it doesn't have to be annual income. It could be more often than that. It could be quarterly. It could be monthly. More often than not, what I see is quarterly. The tax savings, the triple tax savings, the capital gains tax avoidance, all this kind of stuff is all pretty similar through these various strategies, whether it's a gift annuity or charitable trust. So let me go through an example of a charitable trust. Um, Property is gifted to the trust. Off of that trust, regular income stream is being provided to the beneficiary or beneficiaries. At the death of those beneficiaries, or of that beneficiary, the contents of the trust then goes to the charitable organization. Hence the name Charitable Remainder Trust. The remainder left in the trust goes to charity. And it doesn't have to go to one charity, it can go to multiple charities if that was the objective of the donor. If the donor wants to act as their own trustee of their charitable trust, they can do that as well. But I have found most people don't want to hassle with the administration of this kind of stuff. And so very often the nonprofit, the charity becomes the trustee. So in this example, working on behalf of the university foundation, the foundation could easily be the trustee of a charitable trust. By the way, under that gift annuity strategy, that is just a simple contract between the foundation and the donor. Uh, it's a legally binding contract that just simply lays out, you give us this asset, which is valued at this dollar amount, because, obviously appraisals need to be done in advance to make sure that we're following the rules that the IRS has set out for us to follow. And so we would be looking at uh, just paying this, again, percentage uh, out to the donor over the course of their lifetime. And then once they've passed, that's when we can then use that money for the other intended purpose of programming and, whether it's scholarship or, putting it toward, well, whatever the donor's intent was. So here's numerically the example. In this case, I'm saying it's a $500,000 appreciated asset. Their cost basis was $100,000. And so the taxes due on the gain, if they were to uh, sell it at a 30% combined federal and state bracket, would be $120,000. The amount left to invest would have been $380,000 at a 7% rate of return. That's an annual revenue stream of $26,600. And in this particular case, I am using number of years for the donor and their spouse, so 25 total years. So 25 times $26,600 in annual income works out to be a grand total of $665,000. Now let's instead do this through a charitable remainder trust. It's now all of a sudden, again, the value of the property is 500,000, but there's no taxes due, there's no capital gains tax due, and 7% on a $500,000 asset now ends up being $35,000 annually over 25 years, ends up equating to $875,000. So think about that difference between 665 and 875. And that's just on the income stream. Under the charitable trust, we also remove that asset from the estate for estate planning purposes. Therefore, no estate taxes are going to be levied on that as well. And I'm not including the charitable deduction that you got under either of those. So the value of this strategy is pretty immense. And you might be asking yourself the question, well, when do you use a charitable trust versus a gift annuity? Well, I'm a believer in the keep it simple rules, and therefore, if the donor is looking for a fixed payment, wants to know what their income stream is going to be for the rest of their life, and or they don't necessarily need control over it. They want the administration to be handled by the foundation, as an example. I'd go with a charitable gift annuity. If, on the other hand, they feel like a 5% income stream is not enough, because typically the foundation can afford to pay about a 4 to 5% income stream on a gift annuity. Why can't we go higher than that? Because our investment results are typically about 7% gross rate of return over the long period of time. And our expenses end up being about 2%. That then leaves us 5% to be able to pay out. And so, we're trying to be prudent with our money, of course, and we're, stewards of your money. And therefore, we want to make sure that we're not taking undue risk in that regard. So if the donor is comfortable with a 5%, 4 or 5% income stream, then again, a gift annuity seems to make the most sense because it's a simpler tool to employ. A charitable trust would need to be created via an attorney. There's a lot more administration that goes into it, and it's just a much more complex tool. And again, the reason why people choose a charitable remainder trust more often than not is because they want to control it. They want to be able to manage the underlying assets over the course of their lifetime. And frankly, they want to be able to get a higher rate of return by doing that. There's also another type of trust called a charitable lead trust, which is kind of the mirror image of the remainder trust. Remember, in the remainder trust, the income stream is going to the donor or other beneficiaries, and then the remaining assets in the trust go to the charity. In this case, it's kind of the opposite. The charitable organization receives the income stream over a period of time, and then the contents of the trust revert back into the family, either back to the donor or to the donor's heirs. Usually, this is a term of trust, or a term of years trust, excuse me. And typically it's not longer than 20 years. In fact, I don't believe you can go longer than 20 years. Very often we see, like, I don't know, perfect example. We're entering into a capital campaign right now. Maybe you have an asset that's generating income that you don't really need that income from for the next 4 years, and you want to contribute to the capital campaign over the next 4 years. Perfect. A charitable lead trust would allow that income stream to come to the charity. And then after the 4 year mark in this example, the asset reverts back to the family so that they can uh, use that income stream for other purposes at that time. Again, lots of flexibilities in this case. And you might say, well, then Why wouldn't I just donate the income stream from that asset? Because you're not getting the tax benefits, the same tax benefits by using a charitable deed trust. You get much more in tax benefit by using the charitable trust than you would by just gifting the income stream outright. I do have an example of a charitable deed trust, so maybe I'll get into that real quick. In this case, I'm using, for better or worse, a $100,000 asset. Rate of return on that asset, 7%. The amount charity receives then each year is $7,000. In this case, we're doing it over somebody's life expectancy. So it's, again, in their case, an 8-year life expectancy. Therefore, that would be about $56,000 that would be paid out to the charity over the course of those 8 years. And the in essence, present value of that income stream ends up being 37,912. Why that's important is because what the IRS wants to know is what's the present value of that gift? What's the present value of that expected income stream that the charity is going to get over all these years? And the calculation based on their tables and so on is $37,912. So that's what that's part and parcel to what, in the eyes of the IRS, what the gift is. Remember, in this case, the asset's not being gifted to the nonprofit, the income stream only, and then the asset is coming back into the family. These are relatively complex strategies, and so then therefore they have to be reviewed by your accountant and your financial advisor, maybe your attorney, depending on where the conversation's going, especially if you're going to get into a charitable trust strategy. So this is not to make you an expert on this. This is just to open up your eyes to ways that you might choose to give to be able to enjoy, again, like I said earlier, the fruits of your gifts earlier rather than waiting till death. Because what I've also learned is nobody gives money to charity unless they know it's not going to adversely affect their future financial independence. So, one of the best ways for me as an advisor to help people is to calculate how much do you need for your future financial independence. Then what's left over, you could consider giving away. And we might choose to, give only a portion of that away just to make sure that we're not running into any problems. So it might be a combination of using some of these planned income, planned giving strategies along the way, and then also coupling it with some bequests down the road, through your will. Other personal property like art, antiques, collections, and so on, jewelry. These are all different assets that could be considered as part of a charitable gift. And there are different rules. Remember I said cash limited to 60% of AGI for the deduction for the deduction. In this case, it's a 30% limitation. Um, there's a number of different rules around this stuff, but again, working with your accountant, your financial advisor, and your attorney will help make sure that the rules are being followed and you're doing it in a quality way. There are some times when we've set up folks who have gifted their home, where they retain a life tenancy in it, meaning that they gift the house now, retaining the ability to live in that home until they die. And then after they die, then the charity, in essence, can sell the home, take the cash proceeds, and invest it in the way, into programming and in the way that the donor wanted it to be used, whether it's for nursing or it's for the College of Ag or it's for, the College of Business or whoever or however that donor really wanted that money to be used on behalf of the students and the university. I don't know that I need to talk much about a bequest. That's pretty straightforward. Bequest is just a simple designation in your will as to what you want done with your money when you're no longer here. And then you'll notice at the very bottom here, I did say, please consult your tax, legal, and financial advisor to understand how each of these tools might work in your specific circumstances, because everybody's just a little bit different. And it's really important to make sure that we've got a good handle on how this is going to work for you specifically. All right. Well, that's kind of the thumbnail sketch of what I wanted to get into with you. I'm going to stop sharing that document. If you want a copy of that document, we can certainly make that available to you. If you have questions, you want to maybe explore some of these strategies a little bit further, Please feel free to reach out to any of our development officers at the foundation. They're there to help. And at the end of the day, this is about solving your goals, helping to achieve your goals, not necessarily, what the foundation's goals are. The foundation is here as a service to help you, not to, be a hindrance or to, direct you in a way that doesn't make sense for you. So, again, every one of our development officers are very keyed into that. And I would simply close by saying, go Mavs, and thanks for your ongoing interest and support of the university. Have a great rest of your day.